everyone, welcome to Thursday. Now today we're going to take a look and compare ticker code VOO, which is the Vanguard ETF or exchange traded fund, into the S&P 500. And we're also going to take a look at USG, which is on the New Zealand Stock Exchange and is also investing into the S&P 500. Before I do that, let's go through the disclaimer, and that is that this is for educational purposes only, definitely not intended to be personalised financial advice. For that, you obviously do need to go and have a chat to your own financial advisor. Right, let's take a look. To begin with, up here on the screen, I've got the Vanguard S&P 500 ETF up, and I've got this over a 5-year period. You can see that it's obviously trading at all-time highs. In fact, if I go and change this to all, we are well and truly up at all-time highs, which is absolutely fantastic to see. And the US stocks actually all of this year have been having an absolute phenomenal run. Now, you did see obviously a drop-off down through this April period, and that's where the tariffs were announced, and then obviously it's taken off again, which is great. The Vanguard S&P 500, so it invests into the Standard & Poor's 500, which is the top 500 companies on the Standard & Poor's Stock Exchange for the US market. And this is an easy way to obviously get exposure to that, because it's a heck of a lot cheaper than if you were trying to be buying into the S&P 500. As you can see here, it's $630, and the S&P 500 has probably put another zero onto that, just to give you an idea. So this is a more cost-effective way to do it. Pays regular dividends. You can see here we've had September, then July, so it's obviously paying roughly quarterly dividends. So that's really a good option as well. Now, if you follow me regularly, I don't invest just solely for the dividends. However, on an ETF like this, dividends can play a really big role, especially if you use dividend reinvestment plan. And that is where you forgo receiving the cash and you actually allow the fund to buy more units for you. Because the reason it can be a really good cost-effective way is you're not paying brokerage on the new shares that you're purchasing. So it can be a great way to increase your exposure without having to pay, like I just said, brokerage fees for it. Let's go and run our normal indicators on. So we'll pop on our normal moving averages. We'll pop on the 30 exponential. Here we go. And you can see that it's moved quite a way away. It's generally tracking up. It's looking good. I've got no complaints whatsoever about this fund. Let's also pop on the 15-week moving average. The 15-week moving average naturally is tracking the actual fund performance quite closely, and that's what I would expect. You can see here there was what we refer to as the golden cross, so that's where the blue line or the 15-week moving average crossed through that 30, and that happened sort of around May earlier this year. So it's really good. It looks really healthy. We'll just go and take a quick look on the 1 year. Now, the 1 year chart brings these candles down to daily, and look at this. We've got a lovely little gap up here. Now that is roughly trading for Monday the 27th, you can see. So when the market has a gap like that, and we've had 2 in a row, what that means is that after hours and even before the market opens, there has been a lot of buying going into the market, which is great. And it causes these gaps between one candle and another. So in other words, where it closed, you can see here at the top of this candle versus where it opened in the following one. And then obviously it closed above that again, which is great. And then we've got quite a big gap from Friday to Monday. Those are positive signs on the market. Let's just go back to the 5 year. I'll just take those moving averages off. And let's look up USF.NZ. So here we have exactly the same fund, but on the New Zealand market up on the screen. So again, I've got it on the 5 year reporting, which gives me a weekly performance return on this particular share, which is great. Now, the thing with it on the New Zealand market, it invests over 99% into the Vanguard investment. So what is happening? You are paying a little bit more in fees, because obviously you're paying for the managed fund in New Zealand, plus Vanguard charges a fee as well. So you are doubling up on fees if you went into the same fund but on the New Zealand market. The thing that you need to take into consideration is the fact that if you're investing into the S&P 500 via the exchange traded fund or the fund that's available through Smart Invest on the New Zealand market, you will not be exposed, if you like, to FIF rules, which are the foreign investment fund rules, because this investment is denoted back in New Zealand dollars and it's a New Zealand-based investment. So that is something that you do need to take into account if you are wanting to do this sort of thing. Now, I can't make a recommendation or a suggestion either way as to which is going to be appropriate for you regarding tax rules, but that you do need to go and have a chat to your own tax advisor. What I do know regarding the FIF rules, though, is the moment you get over $50,000 New Zealand exposure, then you are going to be attracting those FIF rules. So that's something that you do need to do your own research on. Let's go and have a look, and we'll pop our moving averages on just like normal. So again, we'll pop on the 30. Here we go. And it's looking really similar to what we saw with the Vanguard exposure. And we'll just pop on the 15 as well. So exactly like what you would expect for the Vanguard. We're in that upward trajectory. It's looking really healthy. The market's trading above both the 30 and 15-week moving averages. They crossed sort of a little bit later around the end of June, but we've still got a nice upward trajectory. We'll take a look at the 1 year chart. Now, the interesting thing here versus the Vanguard is, if you remember on the Vanguard, we saw a nice little gap forming between Thursday and Friday session, and then again Friday and Monday. We're not seeing this on the New Zealand market. Now, what that could be, and I haven't looked into it, but it could well be the cross rates, because obviously this is based in New Zealand dollars. Whilst it's unhedged, it doesn't have a hedging exposure, so you are going to be susceptible to currency fluctuations when you invest in the New Zealand market, as you would by investing into the Vanguard. Naturally, if you invest into the Vanguard, you buy the US dollars and then invest into it. Whereas in the New Zealand fund, you are buying the units in New Zealand-based dollars, and the fund is taking care of those exchange rates, those cross rates. But you do have currency exposure. So what could have happened is that the New Zealand dollar may have depreciated a little bit against the US dollar on the last 2 trading days. So that's something that you do need to take into account. Still looking healthy though. For New Zealand market, we could be sort of forming a little bit of a resistance up around that $20.70 mark. Who knows? We'll just keep an eye on it. But like I say, that's actually another step in there, another layer in there, is the cross rates. Because under the New Zealand market, we have to, when I say we, any funds that are invested on the New Zealand market, we have to take that into consideration in every time we report or any time there's any reporting done. If you're investing into it on the US market, you've already done the US cross rate yourself, so it's just reporting to you in US dollars. But if you were to go and create a graph yourself and put it into an Excel spreadsheet, create a graph, and revalued it every day against the cross rate, you too would probably see some sort of movements very similar to what we're seeing here. Now, while I'm recording this early Monday morning, and all of a sudden you can see this little green candle has popped up here, which is a very, very strong sign. So we have actually got that gap. Bear in mind, because we've had a long weekend here, this fund would not have been trading yesterday being Monday. So that's why we've all of a sudden got this gap. It's going to open at about 2% up already. So that's a very good, strong sign. Let's take these moving averages off. And I'll go back to the 5-year chart. Now this time, what I'm going to do is I'm going to make a comparison against the Vanguard. So this is on the 5-year chart. So each of these candles is donating 1 week or representing 1 week. The blue solid line is the Vanguard and the candlesticks are the New Zealand market. So at the moment, the New Zealand fund is outperforming the Vanguard. And that will be purely because of our cross rate. Our dollar, if you like, has fallen quite substantially this year against the US, which obviously if you were revaluating things back into New Zealand dollars, it's worth more to you. If we start to see our interest rates go up, and this is how the cross rates work, if our rate goes up and it's higher than what the US market is, then naturally you will see our dollar, if you like, it will get stronger. And the reason for that is because it's a supply and demand thing. People want to invest into New Zealand. If it's paying a higher interest rate than what it is in the States, it will naturally attract more investors. Whereas at the moment, last time I checked, I haven't checked today, but last time I checked, we were a little bit less than what the US is. So that's why our dollar has, if you like, fallen so much, and it costs so much more to buy the US. Naturally, bringing it back, it means that we get a better return. So that's why you're seeing that difference there. I really hope that's helped. It's been a good share actually to review. I've really enjoyed doing that, and to give you an idea, hopefully it's worked, as to what options and that are available to you. You have to do your own research. You do have to look and find out what is going to be the best option for you. Only you can decide that, and maybe working with your tax advisor as well, because definitely tax is something that you do need to take into consideration. So I'll stop sharing, and that's been really good. So remember, if there is a share that you would like me to review, by all means pop it in the comments. I generally do try to respond to everyone. It may not be straight away, maybe a few days, but definitely try to get back to everyone. And also, just another reminder, we are certainly having a lot of people signing up for our Introduction to Investing webinar that we're running next Thursday, being the 6th of November at 7:30. So if you want to join, there's still spaces available. Love to see you there, and I've put the link in the description below. So hey, until next week, have a great week, and we will see you then. Take care.